Hey folks, hope you're all well and welcome back to the market structure education series that we started last week. If you haven't watched the first video in the series, I'll link it on the screen somewhere or in the description, and I'd recommend you going back to watch that first before jumping into this, as we're going to build on what we covered there as we span out from a single time frame to cover today's subject matter, which is multi-time frame market structure. To reiterate, this is very much just the way that I view and utilise market structure. There are other ways, quite possibly better ways, but this is the one that works for me, and that's all I present it as, the one that works for me. So let's jump in. What we're looking to take away from the session, we'll build on what we covered in the first session on single time frames, and look to take away an understanding of structural relationships between time frames, how the single time frame is beholden to or driven by other time frames, and how we can use two or more time frames to get a better idea of where the market might be going. We'll understand how I use time frame pairing, which is, as I said, using two time frames to build a narrative and what could happen, and then how to use these pairs as you work top down from whatever your highest time frame is to your lowest. A study on the charts of multi-time frame market structure, and we'll stick to the Dixie on that one because it's quite a good study at the moment, and that's the one we started with in the first session. How to use paired timeframes to identify potential continuations or reversals on the higher time frame, and a quick intro to points of interest and trading ranges, because they're quite key in that discussion as well, and they're what we'll jump into in the next session. As a quick reminder of the structural schematic for the first session, this is the graphic we use to show what a single time frame structure looks like. As I said then, it's never this clean in a chart. We need to dig in ourselves and find this structure by identifying the major swing highs and major swing lows within that time frame. But if we were to perform that work on any time frame and then use the path tool to connect those major swing points, it would look something like this from a schematic perspective. Not exactly the same, but something like it. This is obviously bullish order flow, reversal bearish order flow as an example. In the reverse, it would be a bottom rather than a top, but the premise and rules are still the same regardless of what direction the order flow initiates in. I'm not going to cover this too much more, as that was well covered in the first volume in the series. We're just going to jump straight in and look at it from a multi-time frame perspective. And if we do that, it starts to get a bit more interesting. So let's add the major and minor swing structure from this time frame, whatever that time frame might be, and the time frame minus one. And as we can see here, this gives us structure inside a structure, and we can see, even for just this hand-drawn example, that even though the major impulse waves, like the first leg from origin to the first high on the left, are bullish, inside of that time frame minus one structure contains both bullish and bearish order flow. So markets don't ever go up or down in a straight line, because price is fractal. And this is what I mean certainly when I say that price is fractal. The structure that you see in your high time frame, so the darker path there, that same structure exists inside every single leg of that on the time frame down. Then in every leg of that time frame down, this structure exists again, and so on and so on and so on. So price is fractal. That's the perspective when I say price is fractal. It can be quite mind-boggling to think about that way, which is why I like to pair the time frames and use those pairs to work top down to form the narrative on where price is likely heading in my own head. The higher time frame is the one that I'm looking for a destination or a draw on liquidity. And then the journey in terms of how it's going to get there is the time frame minus one, and then working those pairs down from top to bottom. And this works the same on every asset, every pair, and every paired set of time frames that I've certainly tested it on. So what are those relationships, and how do we map them together? So in a bullish scenario, like on the left hand side of the example, when the higher time frame is bullish, and that time frame minus one is bullish in terms of their major structures, they're in confluence, and I would read that as impulsive continuation. In that scenario, I would be looking on the high time frame plus one for points of interest that it might impulse to, and then looking within that on the time frame for signs of structure breaking to say that that's it. It's reached its maximum of that impulse, and it's going to start a retracement from there. If a retrace has already completed on that time frame, so if it's reached a higher time frame point of interest, retraced, and that retrace is completed, I would be targeting notionally the previous time frame range high as the draw on liquidity, and looking for the lower time frame entries to get to that draw on liquidity. Conversely to that, if the higher time frame is bullish and the lower time frame flips bearish, we're looking to see there if the higher time frame has hit any points of interest on its parent time frame that we'd expect a reaction from, just so that we can confirm that was an area that we would expect to see the impulse stall and a retracement start. And we would assume that at this stage that time frame was then in a retracement, and that retracement is being driven by the structure on time frame -1. So if we consider it like the daily, for example, so the daily is impulsive, it breaks into new highs above its previous range high, it goes into a point of interest on the monthly or the weekly chart that we would expect a reaction from, and then the 4-hour chart breaks its structure to the downside. That would signify that the daily is in a retracement from its parent time frame point of interest, and the H4 time frame is the time frame that's driving that retracement, having broken its own structure. And then in that scenario, we'd be looking for internal range liquidity within the daily time frame, within the higher time frame range liquidity, in the form of point of interest inside that range that was just created between the previous low and the new high after the impulsive break of the previous high. And we'd be looking for that to see where we might reasonably target where that H4 bearish move may terminate and return a confluence with the daily move, at which point we'll be back into the previous scenario where we're looking for an impulsive move through the range high. So it just helps us to form a narrative on what type of liquidity we're targeting on the lower time frame. Is it external range liquidity because we've reached a retracement target and we're now impulsing again? Or is it internal range liquidity because we've reached the high that we would expect to reach and we're now going to retrace into that range before either continuation or a full reversal? So that sounds a lot more complex than it actually is, but once you play around with it on your charts, hopefully it makes more sense. And I would encourage you to go into the charts and try mapping it out, having a look at it, and see if you can put it together, and it'll make more sense once you've been through the process a few times. The wording on this slide, and this is the last slide before we jump into some charts. The wording on this slide covers at a high level the premise that we just spoke about in terms of if something is in confluence, then we're looking for continuation, and if the time frames are at odds, then we're looking for retracement. And I've also added the time frames that I personally use just to give you an idea of how I look at this. So monthly paired with weekly, weekly paired with daily, daily paired with H4, H4 paired with H1, and H1 paired with M15. And I do look for entries on time frames below M15, but I consider M5 and below essentially the lower time frames for the M15 if that's the level that I'm looking at. But for now, I just concentrate on the M15 as your lowest time frame. You would have to test this yourself to find out if these pairs work for you. You might find that other time frames work better for you in terms of how you look at things, but that all comes from your back testing and strategy definition. That's a whole other subject that I'm not going to say too much about for now, other than if you don't have a documented rules-based strategy and a risk plan, and you haven't back tested that in the assets that you plan to trade, you shouldn't be trading those with live funds, in my opinion. But as I say, that's a different topic. We're not going into that too much at the moment, but keep that in mind, that you really should have documented strategy, documented risk plan, tested it in demo, make sure it works, be confident in it before you start putting live funds against that. Anyway, let's jump into some actual charts and have a look at multi-time frame structure and how we tie that all together. Looking at this in a chart then, to bring it to life a little bit. This is the Dixie Dollar Currency Index. It's a daily chart. The daily chart is generally the starting point for me in terms of top-down analysis. mainly because I target intraday and lower time frame entries and exits. I will look at weekly and monthly if I'm looking at a macro view, or if I'm looking for points of interest on the daily chart. But generally I'll start my analysis on the daily. So we used Dixie last time, so we won't go through mapping out the single time frame structures again. So this is the daily major swing highs and major swing lows on the daily at a daily level. So this is the major structure from a daily perspective. So to put it into perspective with that schematic, if I throw on a path tool to that to see how that looks, you can see it's starting to kind of look relatively similar to what we saw on the left hand side of that the schematic before in terms of the bullish order flow. If we then look at the 4 hour and how the 4 hour fits inside of that, and I'll drop it down just to the last couple of impulsive moves, so that it's not too much on the screen to be looking at. So if we look at this section of price action roughly from a 4 hour perspective, and I throw on the 4 hour major structure alongside that, and then a 4 hour path, it hopefully makes it a bit more obvious what I was trying to say with that schematic drawing. So you can see that the larger fractal of price at the higher time frame, and then within each leg of that there is the lower time frame same fractal of that price. So we see here on the left bearish order flow, reversal with a break of the major structure high and a retrace back in, and a bullish order flow, and then we see again reversal here on the lower time frame and a bearish, and then a reversal again, and this is what signifies the path for the larger time frame. And if I turn off the candles altogether on that and take away the major structural points and just leave the path, you can see to a degree what was in that schematic in terms of how within each leg there is the same fractal of price. It's not exactly the same in terms of the price and the way the price moves, but there is that fractal of bullish and bearish moves within that. And if we went to the lower time frame, which I'm not going to drop down to the H1 because it would just confuse this too much, but inside each of these legs, so this up leg, this down leg, you would see this same action here. So this move up and down here, you would see that same fraction on a fractal on an H1 inside this up and this down and this up and this down and this up and this down. There'll be a different number of major swing high and swing low points. It's just a general idea that the fractals are the same, and the way that I look at structure, not only the fractals are the same, but the method or the points at which reversals become obvious become the same as well. So if we look at this leg here, for example, we've got bullish order flow with higher highs and higher lows. We get to the top and we see this low is broken for the first time here, a failure swing that doesn't get back above the previous high, and then another low broken. So that would signify that on the H4 this is a retracement of the daily now. Now we don't get much more out of that, you only get the one more leg before it then breaks this high here, which would then have you back to neutral looking to see what happens after that. So this high is broken, sets a higher low, breaks that high, retraces back in, and in this scenario with the parent order flow being bullish, so we can see the daily order flow is bullish here. If I saw this play out in terms of price, where this structure is broken, sets a high, pulls back in and breaks that structure again, I would be looking in here on the retrace of this trading range, so this low to this high, for something that would target initially this first high, but overall I'd be looking at points of interest above this high, the daily high from the higher time frame, as to where that price might go to in future. So my first partial would be on the time frame that I'm taking the trade on, the high within that. I would have a second partial at the higher time frame high, and I would leave a fraction within the trade looking for whatever the point of interest on the higher time frame chart is. So in this scenario it would be a weekly chart or a monthly chart I'd be looking at to see where the daily would go. So hopefully that brings it to life a little bit in terms of the fractal nature of it within the price legs. We'll dig a little bit deeper into the points of interest and the trade setups and potentially some of the entries and exits you might look at in future videos. But this really is just an example of how, when you pair the time frames and drop down like this from a daily into an H4, you can try and see where you're going to be going. How would we then go about using that information to try and inform decisions that we're going to take in the market in terms of direction and where we might be looking to get in and get out? So if we go back to the daily chart again, and we have a look at the daily path and the daily major structures, and we'll take this bit in the middle here just as an example. So this swing low here to this swing high and swing high break to this retrace to this swing high break. Let me take that out and just make it more obvious, the one that we're working to. So we'll work to this one, this little bit of price action here. So as price is climbing here and breaks this high, we'd be looking for areas at which it might extend to. So the easiest one to throw on first, and the one that I would always use is a fib. So on the previous range, so this previous trading range here from this low to this high has been retraced and it's now breaking out beyond that range. So 618 to 1 gives a reasonable kind of initial area to look at. And if you look at 618 here on the daily, just in this price action, you can see that actually the candle bodies respected that fairly well. We had a price spike through it, candle body close below it, and then rejection from there. So that's one way we would build a point of interest in there. So if we throw a horizontal line on there, and then the next thing I would want to do is have a look at this previous high, so this one, and jump up to the time frames above, so weekly and monthly, and see if there's anything of interest there that might be an area where the daily impulsing would meet some pushback. So if we jump to the weekly and scroll to the left and see what we can see in there. So this lower line is the previous high, this upper line is the 618 that we've already identified, and we can see there on the weekly that 618 falls in this gap here between this candle's high and this candle's low. So that's a classic ICT fair value gap, and the price has reached back into those a few times, but we can see on the weekly it's all wicks, there's no body closures in there. So generally I would always consider that to still be an area of interest until we've seen candle body closes within that on the time frame that we're looking at. So if we drop back down to the daily and have a look in that area and see if we can see what happened there, just to confirm that it was wicks and not bodies. And again on the daily we can see it's quite clean here that this line, we had one little body poke into it there, but generally just all wicks before heavy rejection away. So given that's close enough to the 618, which is that bottom green line there, I'm going to take that one out. I actually think that would be the reasonable kind of area of interest that I'd be looking at when price moves in there from a daily perspective. What does the 4 hour do after that? So if we jump then back to current time and have a look and see where that actually hit. Sorry, scroll. So there we go. So this top area on this impulsive swing here after this range break in line with the 618, that area was the area we identified there as a point of interest that we'd be looking for a rejection. And you can see there just by scrolling back, it wicks in very similar to the previous price action. The body rejects and then we see instant rejection away on the daily. So at this point in time I'll be dropping down to the 4 hour chart and looking at structure on the 4 hour chart to see what happens when it gets into that area. So we can see here, I don't have the previous structure marked in here on that chart, but this was the major low and the major high, and we can see price goes in here and then rejects away and breaks that low. So that to me would be a reasonable sign at that point in time that that point of interest was one worth paying attention to, and that we were going to go a little bit lower. And we see again we get a failure swing back in there and another break of that low. So at this point, when we set this low, that to me is a confirmation on the lower time frame, the one below the daily, that the daily is now taking a retrace. So the daily is still bullish and it's posting higher highs, higher lows, higher highs, higher lows, but it never goes up in a straight line, so it has to take a retrace. The H4, which was bullish in line with the daily, which is where we're looking for the impulsive targets as we spoke about before, the H4, the time frame down, is now broken bearish, which signifies that the daily is retracing within its trading range, and we then start looking for reasonable places on that trading range that the H4 may pull back to. So if we jump back to the daily again, we would be looking within this range. I'll stick a range on for you so you can see which one is which. So we'd be looking in this range, somewhere in discount, so in the green shaded area, where the daily may take a retrace back to. So again, first easy thing to look at is what would be the fib retracements on that. So if I look for anything between 618 and 786, we can see that's there, and straight away we can see, obviously we don't know this price action before it gets there, but we can see that it actually hit the 786 and moved on. But what I'd be looking at in there if we hadn't seen all of this before, so let me just stick it in replay, so we'll go to there, and I'll take that structure out so we can't see it. There we go. So what I would have been looking at here is any points of interest on that daily below equilibrium. So that fair value gap there would have been one area of interest, and I would also have looked most likely at, let's see if there's anything else in there. There's another little fair value gap there, which would have had to been mindful of, but it's quite deep within the retrace range. We could use this candle here. I wonder if there's anything more useful on the weekly. So occasionally you have to do this in terms of jumping up the time frames, so you can jump to the weekly and see if there's anything there of interest, and straight away we can see there's this little order block here on the weekly. So I generally, I know it's not ICT perfect, but from a lot of kind of testing that I've done for my own ends, I like to use the wick to the bottom of the body for the order block. So if I stick that in there, and we can see that's a weekly order block. And incidentally, you could make an argument that this over here is also an area of interest. So that entire down combination of down candles there, the top wick on that could be something you could look at as well and say that might be an area of interest. So let's put that on in terms of that, which coincides quite nicely with that order block, and potentially this, which I'll not jump up to the monthly, but that may well be a monthly order block. But either way, it's an area of interest in terms of a previous high. So that would have been the three areas I'd have been looking at within that price action, as to where the 4 hour may retrace back into for the daily to complete its retracement. So what we're looking for at this point in time is where is the daily likely to complete its retracement, and the logic in that is essentially, if I stick those H4 structure points back on, the logic in that is essentially, we know now that the H4 is bearish, so we're looking for where might that bearish structure end and the daily return to bullish in order to target this high. So within this structure you could be looking for shorts and saying, I'm going to short until I see price get into one of these areas. Now, in this scenario you would be targeting shorts in the first one, because it just makes sense. You would want to target the first area closest to price and not be overshooting, just in case you do get rejection from there. So as soon as we see this first break low second break, you'll be looking for some sort of retracement into this small range on the H4 to see where might be a reasonable area for getting short. And again, you can see in the H4 here, there's a little fair value gap there that coincides with the optimal trade range again. That might have been your short there at that point, targeting this area and taking your risk off of this high. And that's one of the kind of key points to this method, is it gives you a good area to take your risk off. So if you were going short there, and I know I'm cheating a little bit because we can see this price action, but just for example's sake, if you were going to take an entry at, let's say, the 705, you're wrong if price goes above this high. So you can have your stop at that high, which gives you a reasonable area to take your risk off, and you're targeting then within this point of interest. Now for me, the 0.265, just below the 0.27 fib, is a reasonable kind of place to target. So you can see that gives you a reasonable RR in terms of 2.68 on that trade, and you would just be following that through to here, taking a portion of your position off there and holding however much you want to keep on looking for the lower targets. For me, if I'm counter trend, I would tend to take the majority of the position off at this point, because it's counter trend to the higher time frame, to the daily. We know it's hit an area that it's likely to retrace, and even though it does eventually, if I exit replay mode, wherever that's gone, there we go. Although it goes further, you can never be sure how far it's going to go. So counter trend, it's not worth it. It's not worth the longer risk in being in your positions. You better get out, in my opinion anyway, with some of your profits. As it then keeps going and it keeps breaking lows, you can start looking for other points of interest below. So the order block and the wider kind of high that we marked out here. And incidentally, we marked that high in the weekly, and we can see there that it got to, what is it, 104,643 was the high we marked in the weekly around about that order block, and the low was 104,636, 104,636. Yeah, so it got just below that 643, so it was almost right on the bottom that line. At this point, when it gets in here and we see highs start to change, so we get a little bit of a shift here, so where it's a low, a high, a low, it then creates a high and a low, but never breaks this high. So we never get that third point in the reversal. Remember, it's only candle body close we're looking for, so this little wick above and this becoming a major high. This only becomes a major high because it's the highest point before this low was broken. For this to have been a reversal at this point, that would have needed to be a closure above here, and then we'd have been looking for longs, assuming that point of interest had been hit and we were going the other way. But as this then wicked above but never closed above, we would still have been cautious, at least at this point. When it breaks this low again down to here and sets this low, we're looking at this point in terms of, is this a full reversal? Is it going to fall out the bottom of this 4 hour range, and the daily range at this point, and then we're looking for potential daily failure swing, lower low, and a full reversal at the higher time frame level. But here we get that bounce in this area, we become neutral again at this point. It moves on to break the high, come back to break the low, and then break the high again. So then again, we're looking here in terms of, this is a 4 hour high range high break and a daily range high break at this point. So we're then looking again for where's the next point that it might fall over. So same process again. So you can see sometimes you get really large impulsive moves and large range changes in there, and if it's a daily you're looking at in a 4 hour, you can't always catch that move if you're looking at the 4 hour. But this is where the paired time frames and working your way down top to bottom would help you, because you would be looking at this and saying, well, the daily is taking a retrace, which means the 4 hour is going to be bearish. The H1 is going to be within that structure of the 4 hour, so that's also going to be bearish. And then when we see the H1 change posture from an H4 point of interest, that might be where we go long. Or the H1 is bearish, but the 15-minute changes posture, you can be looking at the 15 minutes and layering your positions up on the lower time frames. And that's how you do the kind of top-down analysis. So we're not going to jump into that at the moment because we're going to go over points of interest and ranges within the next session. But it's just to give you an idea how you would kind of build that, but how you can use the major structure within each time frame to see where the higher time frame is within its movement and what areas you would then be targeting within that. So as I said earlier, first target for me is always the range high of the entry range, and then you'd be looking for range high of the time frame above, and then a portion to run towards whatever other areas of interest you've got within that. So if you're, for example, on an hourly chart and you've taken an entry in an hourly chart, target the range high in the hourly chart for first partial, the range high on the 4 hourly chart, which is the higher time frame range for your second partial, and then if that was a counter trend move on the daily time frame, you would be looking at the daily range high for your next partial and just layering out that way. So hopefully that makes sense. Let's wrap this one up. It's been a little bit longer than I thought it was going to be, but it was worth going over that stuff in the charts. In terms of key takeaways to build on the single time frame structure and the sessions to come on point of interest, ranges, and putting it all together. Major structure can be paired on time frames. You need to figure out what time frames are best for you for pairing. I've given you an example of the ones that I use, but we can pair structure on time frame and time frame -1 to give us an idea of where those time frames are headed, or where the higher time frame is headed based on the structure in the lower time frame. That pairing gives us that kind of overall narrative in terms of where price might be heading, and particularly on the time frames that you want to trade, which would be generally the lower time frame, targeting the higher time frame narrative. That allows for the filtering out of noise on the higher time frames in the form of that minor structure, because you know that's likely to be major structure on lower time frames, but you can almost discount that for the narrative and the bias that you're giving yourself on the higher time frame. And the key kind of points in terms of that is in the movement between the time frames, or the relationships between the time frames. Is that when the high time frame structure equals the high time frame -1 structure, i.e. they're both bullish or both bearish at the same time, it generally signifies continuation towards the extremes of the range in that direction. So if both are bullish, you'd be looking for continuation to break the range high. If both are bearish, you'd be looking for continuation to break the range low of the higher time frame. So that's when we're targeting at that point then external range liquidity of the higher time frame. If the higher time frame it does not equal the higher time frame -1, then generally that signifies the higher time frame's in a retracement, and we can target points of interest inside that higher time frame range. So internal range liquidity at that point in time. So if high time frame is bullish and high time frame -1 has flipped bearish, then high time frame is retracing, and where within that range would we expect reasonable areas for it to retrace to, that we can either target for short trades on trend in the lower time frame but counter trend in the higher time frame, or where can we be looking for potential reversals to come from so that we can target trend based continuation moves on the higher time frame. And overall, it's just a nice way to look at structure to help with that narrative or bias for trade direction. There are different tools that we can use for figuring out where the draw on liquidity might be in the directional bias of the market. And this is one that I find is really useful for me in terms of giving me that narrative and that bias, so that I know that I'm trading in the right direction, where probability is more in favour. The example there in terms of if we wanted to take trades on H4 or H1 when the daily is bullish but H4 is bearish, then what trend are we following? And in that instance, it can be a bit counterintuitive, but you're actually trading on trend with the time frame that you're taking your entries on, so on trend on the H4 and the H1, but your counter trend on the higher time frame, because we're working within that fractal. So it takes a bit of getting used to in terms of how you think about that, but it makes sense the more you look at it. And again, this method of pairing the time frames is valid through all pairs. And I also use, although I mainly use time frame -1, there are strategies that work very well when you skip a time frame. So there are strategies that I'll use, for example, that use the 4 hour as the higher time frame, but the 15 minute is the entry time frame. And again, it's all just about doing your testing and figuring out how that pairing works for you and what sorts of pairs you want to use. So that's a bit longer than I was expecting it to be. Apologies for that, but that's going to tie up the multi-time frame market structure one. And I'll go back and look at my notes, but potentially I think we've covered enough in here to tick off the what I had planned for volume 3 as well, in terms of the fractal relationships between the time frames. I think I'll have a look and see if there's anything else I want to cover on that, but I think because we dived into it on the charts, we've probably had a good stab at covering that. So this longer session may well cover volumes 2 and 3. I'll see where I get to when I start recording next week on the next one, but we may well skip to points of interest and trading ranges in the next session. So that's us for tonight. Thanks for listening. As always, any questions, add them to the comments, or send me a message, and I'll try and get to them as much as I can. Until next time, stay safe. My tea's it. Gotta go.